Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Difference between the strike price and the asset value, the exchange rate in this case, is measured by the term moneyness. So we have in the money, at the money, and out of the money. Again, that's what we're talking about today, strike price selection. So I have, this is one category, this is another category, and then this is the third category. So I'd like you to think about these categories. Anytime you're looking at any kind of option, right? We're talking about FX options today, but any kind of option, you're basically looking at three different categories. Now, there are subcategories. Deep in the money options, slightly in the money options, whatever, at the money, slightly, or they're just maybe just out of the money, whatever, far out of the money. Lots of ways that you can slice and dice these categories, but essentially three different ways to look at it. The in-the-money options have the highest probability of remaining in the money. They're most expensive in nominal terms. So deeper in the money options are going to have higher deltas. At the money options are balanced between the two extremes, so the cost is generally less than in the money. I mean, I would say the cost is always less than the in the money, I should say, because the in the money is going to cost more, but more expensive than out of the money. Slightly in the money options have greater deltas than at the money options. Out of the money, they have the lowest probability of expiring the money, lowest cost in nominal terms, and they have the lowest deltas. So, number one, these cost the most, but they have the highest deltas. Number three, they cost the least, but they have the low delta. Low delta. Number one has what I would say high delta. So those are the choices that we have when we're looking at the options market. It's that simple. I know we can, I will get into this in future webinars about the option Greeks, how I can look at options pricing, all kinds of different things that are helpful when you are deciding which strategy you might want to implement. But this is the basics right here. In, at, and out of the money options. Hope you're understanding this, because if you do, you can move forward into possibly implementing a strategy once you understand the risks and rewards of the trades. And essentially, if you understand in, at, and out of the money options, you're going to understand a lot about the options market. In the money options, as I said, have the highest deltas. They have the lowest time decay, especially relative to at the money options. Lower, they have the lowest leverage, and they have the highest nominal cost. At the money options have moderate deltas, highest time decay, moderate leverage, and moderate cost. See, there's a lot of moderates here. And I get this question very often, and a lot of you are probably thinking this. Which strike price should I trade? My answer would be, if you look at 1, 2, and 3. Remember, 1 is going to be highest deltas, so they're going to cost the most. I'm going to call that I, in the money. I, A for at, and 3, I'm going to say it's O for out. If you look at it, if you don't mind me using a metaphor, that we're driving down a highway and there are 3 different lanes, you might want to be in the middle lane, because, again, that's sort of giving you a little bit of both. People who drive in the middle lane tend to drive a little bit faster, driving in the quote-unquote slow lane, or that third lane. But first, number one, is going to be the in-the-money option. Those options are going to move quickest, at least initially, followed by the at the money and the out of the money. So if you're looking at an options chain, you might want to start shopping for your options and looking at the at the money options. Then, if you want more leverage, you would go to the out of the money option. If you want less leverage, you go to the in the money option. So I think that's the best way to start. Start with the at the money, and then move based on your risk reward. to either the out-of-the-money option or the in-the-money option. Or you might want to say at the money option. So out-of-the-money options have the lowest deltas. They have lower time decay relative to the at-the-money, highest leverage, lowest cost. Now, a lot of you probably know that the out-of-the-money options do give you a lot of leverage. That's why some investors that are new to the options market tend to gravitate to the out-of-the-money option. Then they get frustrated because they are not successful with these trades. Well, your success is going to be lower on these out-of-the-money options. Your leverage is higher. You're buying an option for a very low amount, and you're controlling a certain exchange rate. Whether if it's a call, it's the right to buy the exchange rate. Put, it's the right to sell the exchange rate. Big market moves, out-of-the-money options are going to do very, very well. Moderate moves, the out-of-the-money options are going to do very, very poorly. Keep that in mind. More about strike price. There are many strike prices to trade, offering all kinds of different risk-reward choices. Your choice, your selection, should be based on your view of the market relative to the market's prices. You have to think in terms of, yeah, I think the market's going to move, but how can I form a reasonable expectation? Now, do I think the market's going to make a 25% move in the next 30 days? More than likely, that's not a reasonable expectation. Could it happen? It absolutely could occur. Is that something that's reasonable? Probably not. So your view of how far the exchange rate will move and how fast can assist you in your decision-making process. I hope this is all making sense to everyone that's in the room today. And if you have any questions, just type them in the chat box, and I'll handle all the questions at the end of the presentation. Let's get to some numbers. Leverage explored. So let's look at if the currency value is 105, 105.18, and I looked at the U.S. dollar Canadian when I was drawing up these slides. It was trading at 105.18. I might look at 6-week options, 15-week options. Well, I can look at the 101 call, and they were priced at 490, the 103s, and you notice that this is going to be the case in any underlying look at, is that the lower strikes are going to be worth more. So it sort of moves from here that you have the highest values down to the lowest values for the calls. The puts are going to work the reverse. Highest values. Oops, I'm looking at the wrong area. Sorry. Puts are going to be over here. Sorry. So the puts are going to work the reverse, where I have the higher strike puts, and then my prices are going to decline as the strike prices decline. Another thing I want to think about is when I'm buying a deeper in the money option, my responsiveness to changes in the underlying, at least in the short term, is going to be much higher. That's why I'm thinking about buying the deeper in the money option. So for instance, the call delta here is 82. I paid more money, I got more delta. So the delta is going to work down. Of course, in the puts, these put deltas are actually wrong. Sorry, excuse me. These are reversed. So that's an error on my part. The put delta should be 76 for the 109, 63.47, so I have it reversed. Sorry about that. I do apologize. If I look at the second section, though, they are right. These put deltas are right here, that you have the higher strike puts and they have lower deltas. So that's going to work. It's going to correspond, price and delta. Makes sense, right? If I have higher price options, I'm getting more delta. Whoops. I get more delta. Let me draw that again. So higher prices, greater delta.
Please join us again next week. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.